Hi all, John DeRelay, Head of Revenue Management Education here, and today we're going to do a data deep dive into the Phoenix, Scottsdale, Arizona market areas. If you haven't been to one of our data deep dives, it's a great opportunity for us to talk about what's going on in a market. We're going to go look at some hard data trends, take a look at how things are going for both in the past, right now, and in the future, and talk a little bit about strategy and what are the big considerations so that we can make the most money we can this year. We're just starting out our season, so we're starting out with a market that's got generally a Q1 high season, so pretty excited to talk about Phoenix and Scottsdale with you guys. Before we get started, I do want to let you know that this series is sponsored by Wheelhouse. I will be using Wheelhouse market data. I'll also be referencing a lot of aspects of pace and your own kind of information because it's really important to know what's going on in your portfolio when comparing market data. And Wheelhouse has a lot of these tools available to you, and they're actually free. So all of the market report data that I'm going to be sharing with you is freely accessible whether or not you're a Wheelhouse customer. In addition to that, if you need really detailed information to see the pacing in your own portfolio, both year over year against the market, all the way down to the daily level for any group of properties within your portfolio, Wheelhouse offers performance insights for free. All you have to do is sign up an account with Wheelhouse, also free. Link your account and you'll have access to really great market insights and portfolio insights without having to be a paying customer. If you need some help, let us know. We're happy to get you signed up. And let's jump into some market data. Okay, so I'm on the Wheelhouse Phoenix, Arizona market report. This is going to be, again, a free market report that you can access that has a ton of data. We have a bunch of, useful overview data, and we're going to be digging into some of these trends here to see a little bit more granular picture. These are going to be fairly broad. We're looking at a pretty large area for our Phoenix market report. This includes Scottsdale, Mesa, Tempe, that kind of thing. So we're really going to be looking at the big general trends. As you can see, this is a pretty large market area where we're tracking 24,000 listings. Now, I'm going to start out by talking a little bit about how last year went, given that we're at the beginning of the year. Then we'll move into kind of what's going on forward. So last year, if I pull up 2024 and 2025 occupancies, you can see that Q1 started pretty decent, right? We were up a little in January. February maintained an occupancy, started to see a little attrition in March. Part of this could have been the movement of Easter. And then once we hit about spring, that attrition kind of in the occupancy kind of becomes a common thing. Now, this is kind of a national trend. Q1 was generally pretty stable last year. We had a lot of good early booking patterns at the end of 2024. But once we hit about the beginning of Q2, we start to see shortfalls across most major US markets. Now, luckily for folks in Arizona, you make them like a very large portion of the money that you're going to make in that Q1. So that high season has passed, but it's definitely not helpful when you're trying to, pay energy bills, get money and occupancy on the books for owners for these months that are low to also have year over year drops in occupancy. And that trend really continues all the way through the rest of the year. Now, as we go through the spring, as we go through the summer, we see these sustained drops. Around the country, that was pretty common as well. We did see some summer high season markets recover in their high season a little bit in summer, but another kind of big national trend that we saw across the board was once we hit September, big turnaround, and we start to see significant shortfalls everywhere. You can see that that's also the case here. Even though we're getting shortfalls through the summer, that shortfall increases as we hit September and remains pretty substantial as we go through Q4, right? So much bigger shortfalls towards the end of the year. The consumer was really tightening up and people were not spending on travel the way folks in our industry were hoping. Again, that is kind of a national trend. It's something that we also see here in Phoenix. Now, Phoenix, Scottsdale, a lot of these Arizona markets, particularly in the urban side, have been seeing, kind of a few tough years, right? We've seen a few years where things are kind of up and down a little bit. It's one of these markets that has a lot of inventory. It's very easy to be legal there. So we've seen a lot of competition on the occupancy side. I did pull up a little bit of information from the hotel sector. This information's a little, it's not too old. It's a report that's recent, although it is talking about a little older data. It also comes from CoStar, who owns Smith Travel Research. So very, very good source for data. And it does have some other Southwest markets, but I'm going to focus in on this Phoenix one. So it's just giving us a little bit of information about what's been going on in the market, which is fine. I don't care too much about that right now. What really interested me here is this, right? So there's two pieces that kind of indicate to me a little bit of concern as we look forward, right? So one, they're expecting RevPAR to decline as we go into next year a little bit. And really, it's going to continue to be this supply growth headwind. So in the hotel world, Phoenix is reaching a high point of its hotel room construction pipeline. So even though if you've been paying attention to like AirDNA and Key Data, they've been talking about how the explosive growth in short-term rentals is starting to curb off. We're not seeing people grow as much in some of these really large high growth markets like here in Orlando. We're starting to see that slow down on the vacation rental side, and you're probably thinking like, that's great. We're going to start to see these recoveries in ADRs. Well, the downside here is we are still seeing that growth in the hotel sector, right? And that is going to be competition, particularly if you have any kind of like commoditized product. If you're looking at a 1-2 bedroom apartment, maybe even 3-bedroom apartments, you may still have a lot of competition. And part of the reason is it's much easier for people to boom in in growth of properties for vacation rentals. So that growth really started early in the vacation rental sector. As that started to ebb off, it's taken time for that hotel pipeline to build up. And now they're going to start coming online and continuing that pressure on the occupancy via competition. So that's something to keep in mind is as we look at the vacation rental space, we may start to hear information about how the growth is starting to slow, but that doesn't necessarily mean the supply competition is slowing down, particularly if you're in those smaller room types or you're really in an urban location. Now, they do mention that RevPAR is expected to continue to drag through 2026 with a little bit of ADR growth, but again, it's really going to be that occupancy that is going to be the most difficult kind of place for you to be competitive. So let's take a look back at the Wheelhouse data and see what's going on here, right? As we look into next year, and I'll pull off 2024 and put on 2026, we do see that there is some occupancy on the books for all of these months in the future. At a glance, given that it's January 9th, it doesn't look like a lot, but Phoenix and Scottsdale and Tempe and Mesa, if you know, outside of the biggest places, isn't going to be a market that's super duper long term. Like this is an urban market. It's gonna have a short booking window, a booking window that, you know, has been getting shorter, but it is going to be short. So what I did is I pulled up the pacing data for you guys, and I can give you an idea here. So in January, we're about 16%. That puts us a little less, or a little around a third of what's on the books, right? Maybe slightly more than a third of what's on the books. To me, that feels a little low. Usually like to see a market at 50% by the time you start the market. But given that this is a last minute market, it may not be too low. Now, when I pulled up the pacing data, the market is pacing behind quite a bit. Last year at this time, we were around 23 to 25% occupancy. And so we're down about 7%-ish roughly from when I pulled this. And that's a pretty significant shortfall. So it looks like January is in a pretty tough spot, right? That means you really need to be looking at driving your occupancy and maybe giving up your ADR position because January is falling a little short. My guess here is we're seeing some shortfalls in January across the board for various reasons. I think a lot of it is those trends that started to appear in September last year where the consumer is really just not in a position to purchase extra trips, means that these kind of shoulder seasons as they build up into high seasons are much more competitive. And when you look at them, January, April, May, maybe a little bit of October, November, they're not near as sure of a thing that we're going to get the occupancy there, and you got to get really competitive and ideally do so a little early. Now, the story starts to change a little bit as we go a little further into the year, okay? So when we look at February, which is building up into our high season, we have some great dates here. We're about on track. We're maybe a partial of a percent, like 0.1%, slightly behind where we were at this time last year, which means we're within the margin of error. So we're basically on pace for February. Now, the decision that you're going to have to make is the short-term window going to be better or is it going to be worse? And so if you think it's gonna be worse, you probably want to get a little conservative here. You can start making slight adjustments to the rates, try to pace ahead a little bit, and build a little bit of a base of business in case the short-term window is really competitive. If you really are kind of like have a high risk tolerance and you're like, hey, things are just going to be straight up better, you can probably hold your rate and hope that it's going to come in the last minute. But we're pretty much on pace here, and I tend to err on the more conservative side, particularly given that most of last year, 9 months of last year, had shortfalls and then really big shortfalls in the recent 5 months. I would probably get a little conservative here and look to drive a little bit more occupancy and pace a little ahead. Now, when we look forward to March, we do see some pretty good signs. And this is a trend that we've kind of seen nationally, which is advanced booking is still pretty strong, right? Like people I think it keeps throwing people for a loop, because what's happening is we see really strong advanced booking, then the window slows down, and then the short term ends up being a lot weaker than people expect. And so those people that are booking early tend to be ending up on top because they put those early bookings on, they were offering a reasonable rate. And even though we've only got about 9%, we've got about a sixth of what we did last year, we actually are pacing ahead by almost double. We're ahead by 4%. So that's, if we're at 9%, 4% of that is ahead. That's pretty good. So March is looking pretty good. There's definitely people purchasing for March. And it means, I think if you're acting more conservatively, you need to be getting a piece of the pie. And March is really where your biggest focus should be. March and February right now are where you're going to make it and makes potentially some of the biggest bookings, especially if things turn a little bad. Now, looking forward into the last month, we have April, and April starts to be a little shoulder season. But again, we're slightly ahead. We're seeing a little occupancy on the books. And I think what we're seeing is people are being rewarded for this early booking and for having reasonable prices. So overall, kind of a mixed scene here. The high season is looking strong. There is good advanced booking. We do have a little bit of a mixed signal with January. That short term is pacing behind, and it doesn't seem to be catching up. Maybe an indicator that we need to be a little bit more conservative. Now, let's take a look at asking rates. Asking rates are the average rates that are being advertised. And I think this is a really good way to see what the market is doing, right? Occupancy is giving us an impression of how the demand is coming together. Asking rates are giving us an impression of how the market is actually responding. And there's some interesting things here. The first thing is that essentially the market is just pricing really, really high, right? Everyone is pushing rate year over year across pretty much every month across the board. I think there's a few opportunities here. We'll look at this February and March because I mentioned to you that the pacing doesn't look too bad. February, March, April here. January, the market is clearly not responding fast enough given that we're pacing pretty far behind. And then we also see that people are just holding these premiums out across this low season and shoulder season. These didn't do well last year. And like I said, my hunch is that these low and shoulder seasons are going to be really, really tough this year. The consumer doesn't seem to have the extra money to be making a bunch of extra trips. And so I would really advise you to position this pricing against the market much better, right? If we know the market is overpriced, then you have an opportunity to just take the market share. Now, the big question is, hey, the market is pricing really high for February and March. We're seeing in April, we're seeing that pacing is looking pretty good, or at least on track for those months. So does that mean I should be pricing in line with the market? The question I'm going to ask here is, what do the ADRs look like? And so when I pull up this data, it does look like the advanced booking is accepting a little bit of that higher rate, and that's a pretty good sign. Now, this could be skewed a little bit because it could be that our biggest homes are really booking. I don't have this broken down to different bedroom counts, but I can. If we go to lower bedroom counts, you do see a little bit different trend, right? Lower bedroom counts are actually booking by being a little more conservative. They're undercutting themselves a little bit. They're actually undercutting themselves a lot in April. If we go to the 2 bedrooms, also what I consider a smaller room type, we're seeing the same thing. Like these smaller, more commoditized properties, the ones that would be competing with hotels, they're getting that pace by being more conservative. When we look at the averages, it's a little higher, which kind of indicates to me that we're also probably seeing a lot of these bigger homes, these nicer homes really driving the advanced booking. And this is really important for you to consider when you're thinking about your portfolio, right? This differences between your small, more commoditized stuff and your larger stuff means you have to have different strategies. Your bigger stuff, if you're pacing well, continue to drive that price. Your smaller stuff, recognize you're going to be competing with hotels, you're going to be competing with all the supply that's coming over the last few years. You may need to be a little more conservative in order to drive that occupancy. Now, if I come back to this asking rate situation too, there's something else I wanted to look at, and let me reset this real quick. One thing I like to look at is also what the highest performers are doing. Oops, got the wrong year. High performers are really interesting to me. We don't see a big change. I just switched this to high performers. We tend to see that this pricing advertising is still quite a bit higher than it was year over year. Sometimes we see some pretty big differences, right? As we look in the different room types, we do see that the highest performers are really undercutting themselves quite a bit. They're advertising a lot lower on average in order to try to capture that market share. In the zeros, the ones are still a little bit higher, the twos are still a little bit higher. So generally speaking, people are still kind of pushing the rate, whether you're in the highest performance group or the low performance group. I think the big thing to note here is that it comes down to what we see in this ADR trend, which is even though ADRs are up, especially in these months where we see pacing, sorry, I'm on the wrong year, especially in these months where we see pacing, ADR is up, definitely a good sign. The big thing to take away here is these smaller rooms are being more conservative. So if you've got smaller properties, you might need to be more conservative than if you were just looking at the market as a whole, because while ADRs are up and pacing in particular for March and April and a little bit February is looking decent, it's really being driven by a little bit lower, a little bit more conservative ADRs if you're in a smaller bedroom type. Now, something else I wanted to look at with you guys is there's a few big events that are coming up this year that reoccur in Phoenix and Scottsdale area. We have the Barrett-Jackson Car Show, which I think is January around 17th to 25th this year, and the Waste Management Open around February 5th, usually big drivers of occupancy and revenue in the marketplace. Barrett-Jackson is coming up pretty quick, and I just wanted to see how these were looking compared to last year. So you can see here, we have some bumps where these dates kind of come in. We do have little bumps over these date ranges. This is around that time for the Barrett-Jackson Car Show. Then we come over here and we start to see the Waste Management Open. We are seeing little bumps, but really something that concerns me is we're not seeing really significant compression here over the other dates. That is something, especially for this Barrett-Jackson, which is coming up pretty quick, I would really get a handle on that, because I would expect these dates where we would expect a lot more compression, where they had very, very high market occupancies last year, to really be pushing a lot farther ahead of other weekends, and they're only marginally ahead right now. Now, I am looking at everything in the market. If I go to the highest performers, you can see that the highest performers are capturing quite a bit more of that market share. You see a much bigger bump for Barrett-Jackson. You already see a pretty significant bump for Waste Management Open. But the fact that this is different is interesting to me. It kind of means to me that there's going to be some vacancy. And if you're waiting till the very last minute, you might be competing with a lot of properties that are at a lot of different price points, making it much more difficult to get what you want out of it. Another thing too is when we look at the kind of ADRs for this situation, there's a few things to note. It does look like the market is seeing quite a bit higher ADR over here, but given that the pacing isn't looking great, it might be that we're pushing too high. You can see over the Barrett-Jackson dates, rates are significantly higher than where they were last year across those peaks. And then for Waste Management Open, rates are exceptionally high compared to where they were last year at the market level. To me, that looks like the market is pricing too much, and that is actually an opportunity for you guys. It means that you may only have to make some changes to really beat the market and really push yourself up in the rankings and be the thing that people want to book, because the market seems to be pricing a little too high. Now, these are average nightly rates, so ADRs, these are what's coming in. So people are booking at really high rates, but keep in mind, we are pacing a little bit behind. So, you know, there's less people who are booking, and it may be because the rates are too high. If I switch this over to asking rates, we do see kind of a similar situation, right? People are just, the rates are being pushed pretty significantly at the market level across the board. And for January, I'm just a little concerned that the market's not reacting fast enough, and that we may start to lose some of these gains that we had in February. We looked back in December. When I looked back at this data in December, we weren't pacing super far behind yet. And so it does seem like a trend that we see in markets kind of across the country right now in our industry is that we're getting really good advanced booking, but we lose that edge as we get into the middle window, and the market doesn't quite respond fast enough. So when we look at these kind of pricing situations, I think that you may be able to just adjust prices now, and we really probably do want to do it for the Barrett Jackson stuff, given that it's pretty short notice. Now, if I do look at the highest performers, we see a pretty similar trend, but it's just not quite as drastic, right? Rates aren't being pushed quite as much, and that's probably partially what's contributing to them being a higher performer. Awesome. Well, I hope you found this information pretty helpful. Just a quick reminder, those market reports are free for anyone, whether or not you're a Wheelhouse user. All you have to do is go to usewheelhouse.com and sign up for a free Wheelhouse account, and you can access the high-level market data. If you want a little bit more granular market data and really get into specific submarkets or specific neighborhoods, you can get access to that data. We're happy to provide you a trial to build your own market reports. And one more thing is, I mentioned a lot about pacing. I mentioned questions around what's going on in your portfolio. That's an important thing to understand, because while you look at the market, you need to compare it to your own trends. Because if you're way ahead, you're going to act a lot different than if you're way behind what you're doing year over year. Wheelhouse offers free tools for you to be able to see that pacing that go all the way down to the daily level. So you can see exactly what days Barrett Jackson, Waste Management Open, how they are pacing in your portfolio, how they're pacing across your 1 bedrooms, 2 bedrooms, 3 bedrooms, or any custom group you want. And we actually offer these business intelligence tools for free in our Performance Insights. If you'd like access to this, sign up with an account with Wheelhouse. Let us know. We're happy to get you trained and set up so that you can really make the best decisions when both looking at market data and also your own portfolio. We'll continue to do this series throughout the year. We'll probably check in Phoenix after the high season and see how things have gone. And if you have any questions, I'd love to hear from you. Thanks. Bye.